So again, welcome everybody to our commodity and focus webinar, where we'll be walking you through today of the impact that the drought crisis in Europe is having on energy and food prices. This webinar today is being led by two of our experts in the commodities team. We have Nishita, who's our specialist, who's our energy and resins market specialist, joining us today. She's also our commodity and focus webinar veteran, who's hosted a few of these webinars before as well. And then we have Kumar Amit joining us as well, also one of our webinar veterans, who will be walking us through the impact that the drought crisis has had on some of the agri commodities as well as dairy. In terms of the agenda today, we will be first just giving you an overview of what the drought situation looks like, where after which we'll be walking you through the impact it has had on some of the grains and oils commodities, followed by energy, of course, the obvious category which is seeing a big impact because of this because of the summer heat waves and the drought crisis as well. And then we'll close this with Kumar walking you through the impact of this drought crisis on dairy categories and the prices. And of course, we'll close with a key takeaway section as well. And finally, we'll open the floor up for any questions and answers that we may have. So we'll start first with the drought situation. Thanks, Amit. So just a quick recap of basically what really has happened in Europe this year. As we're all very well aware, it has been warmer than usual summer, but technically it has been one of the worst drought situations in Europe in at least 500 years. When we talk about countries, especially like France, Italy, and Portugal, these countries they not only saw a very dry, I would say, winter and spring, but also an accentuated drought situation caused by the early onset of summer heat waves. So almost, as you can see over here from some of the metrics on the screen, almost 64% of the land, and we're talking of agri land in Europe, has been impacted by low water levels, which has put a massive stress on acreage, on yield for a lot of crops. And that impact has impacted not only the supply and demand, but also prices. And we will look into that in more detail. A lot of territories in Europe are also under warning, especially if you think about territories such as in Italy, especially along the Po River, where we've seen massive impact on the agricultural land next to the rivers. And then, of course, because of all of this drought, we've also seen a drying up of rivers, which act not just as sort of logistical channels, but are also feeding into the hydropower output in Europe. So that overall is then not just impacting, as you may say, the logistic side of things, but also then electricity production, and then of course agricultural output, as we spoke about. So without any further ado, I would now pass on to Kumar to walk us through basically the start of the impact, which is the agri side. Over to you, Kumar. Kumar, you're on mute.
Thank you, Sid, and I appreciate you providing a brief overview of the present drought situation in Europe and its effect on different businesses to provide some background information with. Now, to start with, the food industry is one of the major sectors that the drought is anticipated to affect. And if it does, it might experience an unprecedented price increase as essential commodities, including wheat, corn, oilseeds, milk, and their derivatives are affected. Let's start with agriculture commodities, since they have an impact on the price of everything from noodles to cakes and bread. Prices of key grains and vegetable oils, such as wheat, corn, rapeseed, and sunflower oils reached a record high in second quarter of the current year. While much of this rally was driven by supply and logistical challenges arising because of the Russian and Ukraine war, some part of this rally, which started from mid-2020, was also driven by dry weather in Europe, US, and Canada. Having said that, let's take a look how current year drought will likely impact key grains and vegetable oil. As you can see, we have classified the impact in three broad categories: low, high, and medium to high. The impact will likely be higher on grains such as wheat and corn. As for wheat, Europe is the second largest exporter and accounts for close to 17% and 16% of global wheat production and exports, respectively. While most of the wheat harvest was completed before drought intensified across the Europe, it still had an effect on late harvested crop, causing an annual drop of 2.5% in yields for the marketing year 2022-23. While most of the wheat crop was harvested much before the drought impact started flowing in, summer crops such as corn and sunflower seed will be the most affected crop, as yields are estimated to drop by about close to 18% for corn and 15% for sunflower seed on an annual basis. A likely slump in the region's corn output and lower than expected output growth in the US, which is the world's largest producer, will likely lead to an upward price pressure on corn, which will further spill over to wheat as well. Now, if we look at vegetable oils such as soybean and rapeseed, the impact will likely remain low, as Europe is not a major producer or consumers of soybean. Also, soybean production in Latin American countries such as Argentina and Brazil are expected to surge in the next financial year. Moving to rapeseed harvest in Europe was completed before the drought intensified, and hence no impact on yields were observed. As a result, we have seen that rapeseed prices have dropped significantly over the last 3 to 4 months. Also, production of rapeseed in Europe increased by about close to 11% on an annual basis in the current marketing year. Another factor which negated the impact on vegetable oils is the sustained drop in palm oil prices, which fell because of increased export from Indonesia and higher than expected production in Malaysia. Now, having taken a look at the impact of drought on various grains and oilseed, we can now move on and take a closer look at the current drought situation. In Europe, major grain producing countries such as France, Germany, Poland, the UK, and Hungary were battling with low soil moisture before they witnessed some rains in September. If you refer to the red highlighted part, where red patches indicates of extreme drought situation, it shows that overall drought had a heavy toll on the region's corn yields. And as mentioned earlier, it is expected to drop about close to 18%. Now, if we look at take a closer look at a drought dashboard for major grain producing countries, we see that soil moisture anomaly, which normally measures anomalies of daily soil moisture content, is showing an alarming picture for sowing of winter grains such as wheat, which we club with the combined drought indicator, which basically integrates information on anomalies of precipitation, soil moisture, and satellite measured vegetation condition into a single index, we can easily find out that it indicates yield of winter wheat and sunflower seed might get affected because of the high ratio of soil moisture deficit. While situation in Europe remains alarming, if we look at the US, overall situation does not seem very different here as well. Lack of rainfall in September led the drought to spread across central US. The chart below clearly highlights the severe to extreme drought condition in the major grain producing areas. Further, if we look at the pie chart, it highlights that while 75% of the total area continues to experience drought condition, about 51% of total area is facing moderate to extreme drought situation. And the latest number getting published by the various agencies also indicates that winter wheat sowing as of 16 October in the US and key growing regions of the US such as Kansas, Oklahoma, and Illinois is slower than the last 5-year average pace. Overall, only 38% of the winter wheat has emerged by 16th October, which is down 4 percentage points on an annual basis and lower by close to 6 percentage points if we compare it with the last 5-year average. Now, the key question is, why should we show concerns if acreage fails in some of the key producing regions, as output in other key exporting countries such as Brazil, Canada, and Australia is expected to rise, and that should ideally offset the impact. The next slide, we'll see why we should be concerned about the ongoing drought situation. If we look at overall stocks to use ratio of wheat and corn, we see that there is certainly a supply shortage of these grains, and supply remains tight across the world. If we look at wheat stocks to use ratio in Europe, it is forecast to reach a record low in the marketing year 2022-23. Global wheat stock ratio, if we look, it is likely to reach near to 15-year low, which further indicates of tight supply in the market. While wheat situation is really alarming, situation remains slightly better for corn. Overall supply of the commodity will still remain low, and if we look at a stocks to use ratio in Europe, it is forecast to reach 3-year low in the next marketing year. Global ratio will likely remain slightly higher if we look at on an annual basis, but still if we see, it will be marginally higher than the 8-year low which market saw in the marketing year 2020-21. Supply situation, while overall picture if we presented by the stocks to use ratio is still somewhat alarming, it can further aggravate as wheat and corn output in Argentina, which is one of the largest exporter of these grains, is forecast to drop by about close to 22% for wheat and 4% for corn. And that is basically because of severe drought in the country. Now, production disruption because of critical drought in Argentina may prompt the government to revise down wheat export quota and also restrict corn export, which will not be a good news for global grain supply in the next year. Additionally, this can further be aggravated by a projected drop in Ukraine's wheat sowing area, which may fall 30 to 40% on an annual basis for the crop that will be harvested in 2023. And the primary reason of this drop is the lack of funds and increase in finance cost. Now, moving to the price outlook. Having discussed about droughts, we can easily conclude that prices are likely to remain elevated till H1 2023 at least, which will be before the onset of wheat harvest season in the Northern Hemisphere. And that will be primarily because of supply concern emerging due to drought. Prices will also find some support from a likely yield loss in Australia, as widespread rain in the country's eastern grain producing regions in early October is expected to impact quality of about 50% of the crop in New South Wales, which is a major grain producing region of the country. A closer look at the table will give you an indication how supply of wheat and corn will change in Europe during the marketing year 2022-23. If you look at the numbers, it indicates that overall production and stocks of both grains are forecast to drop in the region. And demand for wheat, while it is likely to remain stable, we might see a slight drop in demand for corn, which to a certain extent may offset significant upward rally in corn prices, but on the supply side, overall situation still remains tight. On demand side for wheat, primarily, the two new bioethanol plants, which is expected to restart in UK, Ansas and Webrago, will likely achieve full operating rate in the marketing year 2022-23. And this should likely push up wheat demand from the bioethanol sector. So that's an overall overview of grains market, the impact of drought on grains market. Now, I hand over it to Nishita, who will take you through the impact on energy market.
Thanks, Kumar. Sorry, Nishita, before you jump in, I just wanted to sort of, again, remind the attendees that you can post any questions in the Q&A box. Please feel free to sort of ask any questions you may have from Kumar, and we'll try and answer them towards the end of the webinar. Thanks. All right, Nishita, back to you.
Thanks, Sid. So coming to energy. So the world today is actually in the middle of its first truly global energy crisis, and Europe is the center of attention. The region has been hit by several aggravating factors like the Russia-Ukraine war, and most recently, the drought, which has made the crisis more acute. Natural gas has emerged as a weapon of war between Russia and Europe since Russia invaded Ukraine in February this year. Despite attracting global criticism for funding a war in itself, Europe continues to be reliant on Russian energy supplies. In early 2022, Russia supplied close to 40 to 45% of Europe's natural gas imports, and by October, this has decreased to around 8%, thus resulting in a sharp spike in prices. Now, before looking at the impact of drought on energy sector, let's have a look at some of the key events which have unfolded since the Russia-Ukraine war and triggered the current energy crisis. Now, energy prices had surged in the autumn of 2021 as tight gas supplies collided with strong demand in economies recovering from the COVID-19 pandemic. Also, Russia was accused of keeping oil and gas deliveries to Europe deliberately tight due to tensions with Ukraine and to apply pressure on Germany to authorize the Nord Stream 2 pipeline. In February this year, as the first response to Russia's attack on Ukraine, Germany suspended the certification of the Nord Stream 2 pipeline project indefinitely. Now, Russia retaliated and announced that it will now only accept the payment for gas deliveries in rubles from unfriendly countries, which included the European nations. And as a consequence of this, during April and May 2022, Gazprom stopped delivering natural gas to countries like Poland, Bulgaria, Finland, Netherlands, and Denmark, as these countries refused to make payments in rubles. Pressure on Europe surged when Russia reduced deliveries by the key Nord Stream 1 pipeline by 40% and then by another 33% in June this year. After a 10-day maintenance in July, the pipeline was operating at only 20% of its capacity before coming to a complete halt in late August. As recently as 26th of September, the Nord Stream 1 and 2 gas pipelines both ruptured in the Baltic Sea and have lowered the hopes of a resumption of more normal levels of imports from Russia during the coming winter. Now, faced with volatile supply situation and elevated energy prices, it became important for Europe to have sufficient inventories to cushion itself against any supply disruptions during the winter months. Hence, the European Union had set a target to ensure that the storage side of its member countries are at least 80% filled by 1st November 2022. As of 14 October, European gas storage levels have reached 92%, which is pretty much in line with their 5-year average levels and exceeding the pre-winter targets that have been set by the bloc. Germany, which imports around 55% of its gas from Russia and is home to the largest storage capacity in the region, also has storage around 95% full. France and Netherlands have also achieved their storage targets and are currently more than 90% filled. Now, while the winter supplies for this year look at a comfortable level, there are growing fears about the capability to refill storages for next year without Russian gas. And as the European Union target rises to 90% by the November of 2023. As per some market estimates, in the event of a complete cutoff of Russian gas supply from November this year, high LNG supply, along with at least 9 to 13% reduction in gas demand, is required to reach storage level of close to 40 to 45% of the working capacity by the end of the current heating season. Now, the risk of physical shortages and rebuilding of inventories for the next winter will increase if inventory levels decline below 30% of their working storage capacity by the end of February 2023. After looking at the fears around the supply situation, it has become extremely important for Europe to undertake gas and electricity saving measures to pull down the prices, reduce dependence on the Russian gas, and minimize storage withdrawals to keep inventories at adequate levels until the end of the heating season. To begin with, the European Union has said that it will cut the gas imports from Russia by 2/3 by the end of this year. To help it achieve that goal, member states have agreed to cut gas usage by 15% during August 2022 to March 2023. Countries are also looking to ship in LNG in tankers from producers such as the US, Norway, Algeria, and Qatar. Germany has leased around 4 floating storage and regasification units to quickly start importing the LNG directly and replace Russian volumes. Also, governments are encouraging energy-intensive industries to switch from gas to other alternative sources like oil, coal, nuclear, etc., to lower the gas demand and eventually the prices. For example, Germany has passed a law to bring back oil and coal-fired power plants into the country's energy mix. And this could add around 10 gigawatts of reserve capacity until March 2024. Similarly, the Dutch government has removed production caps from all the coal-fired power plants, which is expected to lower the gas demand by around 2 to 3 billion cubic meters annually. The European Union recently also approved a package of emergency measures to control electricity prices, like mandatory power savings, cap on excess market revenues, and a levy to capture the surplus corporate profits. All these measures aim to lower the gas usage in power generation. Now, an important question which comes to our mind is, what impact does the drought has on the current energy crisis? So the high temperature and drought have only deepened the energy crisis in Europe and negatively affected the electricity production at a time when the region is already facing unprecedented high oil and gas prices. Heat wave across Europe and hotter than normal temperatures added to higher demand for gas in air conditioning purposes. Also, low water levels in Europe's main river due to drought have negatively impacted Europe's barge transport, lowering the LNG import volumes and negatively affected operations at oil refineries. In addition to this, as river and lake water levels dropped to the lowest level in more than 20 years during the summer, hydroelectricity generation plunged. To give you an example, in the second quarter of 2022, the hydropower output of the Western Europe dropped 20% in comparison to an average year. In addition to this high temperature, the warm river water also made the nuclear plants difficult to cool the plants. Similarly, coal power production has also.
Yeah, you might want to just repeat that, Nishita. I think we lost you there for like half a minute or so.
Okay. So due to high temperature, the warm river water have made the nuclear plants also difficult to operate, just like we saw for the hydroelectricity generation, as they rely on river water for cooling the after turbine steam in the internal circuit. In France, which is Europe's largest producer of nuclear power, several nuclear plants were forced to reduce output because the river temperatures were too high to cool the plants. Similarly, coal power production has been negatively affected in Germany because the sinking rainwater levels made shipping along the river difficult and has impacted the operations at the coal plants. As a result of this, the power plant operators have become more reliant on natural gas, despite the intention to reduce the gas usage, and that has pushed up the natural gas prices, which were already pretty high due to the Russia-Ukraine war and have deepened the crisis which the region faces currently. Now, moving on, after understanding the current situation for the European energy market, we looked and analyzed different scenarios which include combination of various supply and demand risk for the gas prices. On your screen, you can see three cases or scenarios: the base case, which is the most probable case; best case, the low range or an optimistic view; and the worst case, the high range or the pessimistic view. Let's take a few examples to understand this table a little better. Now, looking at the Nord Stream 1 supply, we assume that under the base case, the pipeline will remain shut during the winter months until first quarter of 2023. However, an earlier than expected resumption of the pipeline may push the prices closer to our optimistic case forecast. And on the other hand, a prolonged halt in Russian supply, including via Ukraine and Turkey, will be a major jolt to the market and will push up the prices to our pessimistic or the worst case forecast. Similarly, regarding weather, a cold spell in line with seasonal norms is our expectation for the base case scenario. However, milder winters a colder than normal temperature could result in prices nearing the best or the worst case situation, respectively. So, after looking at all the possible scenarios, we present a forecast for the natural gas prices. Natural gas prices in the UK have increased more than 90% since the beginning of the year, and we expect that the prices will continue to remain extremely volatile and rise till the first quarter of 2023. Persisting disruptions to Russian gas supply, delay in the restart of the Freeport LNG export terminal in the US, low hydro and nuclear power generation, along with the risk of an unseasonably cold or long winter, will keep the prices at an elevated level during the winters. However, prices may retreat from the high levels during the second half of 2023 due to an expected demand destruction driven by high prices. The European gas demand is likely to fall by a record 10% in 2022 and another 4% next year because of the high prices. So further, several gas-saving measures adopted by the governments, which we discussed earlier, like higher LNG import volumes, voluntary reduction in gas usages, mandatory power savings during the peak hours, etc., will also support to reduce the gas demand and therefore the prices. And definitely, last but not the least, are the fears of a possible economic recession in Europe, which will further add to the bearish sentiments in the market. So now, as we have discussed the key reasons behind the elevated energy prices and our price outlook for the next year, it is equally crucial to see which categories are most likely to be impacted. Now, on your screen, you could see the impact the energy crisis would have on different categories. Say, for example, the starch industry, which consumes around 78% of thermal energy during production process. And therefore, this category is expected to witness high inflationary pressures. Similarly, aluminium, plastic, glass, etc. all fall in energy intensive categories relying heavily on natural gas and electricity, and therefore are currently witnessing an increase in their production cost. On the other hand, categories like cardboard, natural colors, fibers, they have low energy requirements and therefore are likely to be less impacted by the energy crisis. So now, having discussed the energy sector in detail, Kumar will now walk you through the impact of drought on the dairy sector in Europe. So over to you, Kumar.
Thank you, Nishita, for providing such a thorough analysis of the potential effects of drought on the world energy market. After talking about agriculture and energy market, let's take a look at another important sector, dairy, which is considered to be the cheapest source of protein, though a consistent uptrend over the past year has made it no longer cheaper. As you can see, the map here represents the density of dairy farming and the combined indicator of the European Drought Observatory. A comparison of both charts reveals that the regions affected by drought account for about 75% of the dairy production in Europe. Unlike cereals, where production is directly impacted by a climatic hazard, the impact on dairy farming will be limited as long as the mobilization of forage stocks can compensate for the consequences of drought. Hence, in the past, it was observed that milk production growth fell after a lag of 1 to 2 years from the year of drought. European cattle and sheep farmers are digging into their winter forage reserves during the peak summers, which should not have been the case. And this may lead to lower stocks of forage in 2023, which will subsequently cause a rise in milk production cost. Low availability of feed grains and forage and higher margin for meat processors may push up culling rate as winter approaches, which will further limit potential for milk supply growth in 2023. At this time of the year, all animals should be outside grazing grass, which is the cheapest form of feed. However, severe drought has restricted cattle movement in open fields, increasing the cost for farmers. Poor feed quality and reduced availability of feed and forage may push down fat and protein content in milk. Now, having discussed about an overview, let's move to the price outlook section. So if we look at the chart, prices are expected to remain elevated, primarily because of high input cost and slower growth in milk production due to the effect of drought. Intensification of drought in Europe, US, and Argentina may further aggravate concerns related to food security and might lead to increased demand for dairy derivatives. Another factor which will likely contribute to the upward pressure on prices is shortage of labor, both in farming and the processing industry, which, in addition to supply chain issues because of low number of truck drivers in Europe, will further pressurize prices upwards. Couple of other policies such as Common Agriculture Policy and Farm to Fork initiatives in 2023 may further restrict growth in milk production. Additionally, rising pressure on major non-dairy producing nations to reduce methane emissions may heighten farmer protests, which could have a detrimental effect on milk production. Now, if we take a closer look here, the government of New Zealand is considering taxing farms to reduce emissions, and Australia may make a promise to reduce methane emissions soon. New Zealand and Australia are the largest milk producers in Oceania region. Also, the Netherlands government took a bold step in June when it decided to purchase back about close to 600 of the dirtiest farms and reduce herd size by about 30%. Such a decision has caused a widespread farmers' protest and a drop in milk supply from the region. And that's one of the reasons why prices has remained elevated throughout in 2022. The dairy industry is regarded as a crucial or critical sector in various nations when it comes to the utilization of natural gas. Hence, the respective government may not impose a strict restriction on gas consumption in this industry. However, worries about the affordability and availability of natural gas will persist throughout winter and may have an impact on production cost. Having talked about supply side and input cost side, now taking a look at demand side, global economic slowdown and expected rise in consumers' gas bill in winters may push down retail demand for value-added dairy derivatives in early 2023. Also, a likely reduction in operating rates of the food processing sector may further push down milk demand. So that's overall on dairy industry. Over to you, Sidharth.
Perfect. Thanks, Kumar. Yeah, very, very interesting session. A lot of insights, and I see some very interesting questions also that have come our way. So before we move on to the questions and answers, and I want to keep this one short, I just want to quickly summarize basically what we've discussed today. Literally taking just a minute. I made some notes as well, and you got a good slide also here which summarizes it. So looking at corn and wheat, what we're suggesting is that prices are expected to stay high or elevated in the first half of 2023 as well, primarily driven by tight supply that is caused due to drought, and as well as the disruptions that are being caused by the Russia-Ukraine war. Demand will remain stable, but in fact, if you look at it from a longer term lens, given the macroeconomic uncertainty that is clouding all major economies right now, we may expect a global economic slowdown, which may impact demand longer term. But that's actually the case across almost all commodities. So it's not specifically for corn and wheat. Prices will also be driven, of course, by high input costs, which is fertilizers and financing costs for farmers. Now, from a downside opportunities perspective, when we talk about downside opportunities, we're talking about basically factors that may either limit the upside or may provide a little bit of pressure that may push prices down. Are obviously the fact that there has been record high wheat output in Russia. Number one, there are improved exports from Australia and Canada. So overall, there are some, I would say, semblances of supply improvements as well that could add some, I would say, a little bit of pressure on prices, downward pressure. But overall, we expect prices to remain high in H1 for corn and wheat. Moving on to natural gas, we expect, okay, of course, I mean, given the natural gas situation right now, as we all are aware, our forecast suggests that the prices will continue rising, at least till Q1, and then after that we may see a little bit of flattening in the curve and also a slight drop. But overall, if you look at it, in H2 next year, prices will still be 150% higher than the average 2021 price, and that's quite scary. That's predominantly driven by, as you all are very well aware, the big halt in Russian gas supplies, which is currently one of the biggest issues. Because of the drought conditions, we're also seeing low nuclear and hydropower outputs in Europe, and there's obviously a risk that the winter will be colder than normal. I mean, but that's the case almost every year. Speculators come with that kind of position. But let's see what happens. In terms of downside opportunities, again, we're looking at a slight reduction in gas usage in EU, which might ease off the pressure a little bit. We also could see an increase in volumes outside of Russia, so which is basically non-Russian sources. And of course, same as corn and wheat, we're looking at global economic slowdown as one of the factors, more longer term and macro factors that might sort of keep prices in check from a long-term perspective. And finally, when we come to dairy, prices are expected to see a bit of a drop in H1 next year. As you all are very well aware, in at least the northern hemisphere and part of it is a peak milking season, right? So as we all know, it's called the spring flush. So we might see prices sort of ease off a little bit in H1, because of high production, but overall will remain higher, driven of course by tight supply from key producers, as Kumar was pointing out, which is New Zealand and Australia, and of course also the Netherlands, and elevated feedstock costs. And overall, again, from a downside perspective, we're looking at a slight drop in demand, and of course a weak demand caused also from China. So that's in a nutshell the summary of what we've discussed today. Hope you've enjoyed the webinar. Now we'll quickly move on to the questions and answers, and I see there are plenty of them. So I'll start in a chronological order. So let's start first with question number 1. So what effect will, and I think this one's from you, Nishita, what effect will rationing of gas have on the grain market in Europe? Actually, it's both partly for you and also for Kumar.
Yes, so I'll answer it basically in terms of impact that which we can see is the rationing of gas in Europe will primarily impact fertilizer in production. And as a result, fertilizer prices will likely rise, which should lead to higher input costs for farmers. And just to add here, basically, one of the major fertilizer producer in Europe has already announced cut, and they are because of high natural gas prices, and they expect production to remain close to 35% of their capacity till early Q1 2023. And that's the reason which that's the impact which we see on grains market.
Perfect. Thanks for that, Kumar. I'm going to quickly move on to the next question. Thanks for that, Bert. The person who's asked that question, although it was an anonymous, I hope that question is answered. If not, please feel free to sort of ask a follow-up question as well. Jürgen has asked a question. What about the announced Chinese LNG export restrictions? Will it have an impact on Europe, even at lower rate volume scale, 10% total imports? I mean, basically, will the Chinese LNG export restrictions have an impact? This is that question for you.
Yes, Sid. So recently, like you have mentioned, it's been mentioned that China has announced certain LNG export restrictions, and because in the past few months, because of Chinese lockdowns, China was routing a lot of LNG that it was receiving to Europe to take advantage of the higher prices in the region. So definitely, given that we are entering into the winter season, and with Russian supplies being out of picture, any restrictions on LNG supply coming into Europe will definitely have an impact on the market. So definitely, if we see a long cold winters in such situation, it will definitely be a little bit bullish for the Europe market, these export restrictions.
Okay, perfect. Thanks, Nishita. Jürgen, I hope that answers your question. We'll move on. What are the key factors to watch out for the natural gas market in the coming quarter? Now, I'm not sure what coming quarter means over here. Is this Q4 this year or Q1 next year? But Nishita, maybe you can just quickly highlight for both the quarters.
Definitely, Sid. So, for natural gas, I think the most crucial period to look out for would be the winter, which would be covering most of the Q4 this year. And I think the two key factors which would be playing major role would be the status of the Russian gas supply. So what happens, to the Nord Stream 1 supplies? Also, how Russia reacts, in case there are some proposed price caps on oil and gas supply by the G7 countries, which has been extensively discussed currently. Also, some Russian supply which comes via Ukraine will also be critical to watch out for. So from the supply side, this would definitely be critical. And coming from the demand side, it would definitely be the weather. The severity of the winter season in Europe, that could, if it is colder than normal temperatures, then it could definitely result in rapid inventory drawdowns. And that, coupled with absence of Russian supply, could again be, result in a sharp spike in the prices that we could see in the coming months. So these would be the two key factors to look out for energy market in Europe.
Okay, perfect. Diego has a question. Regarding the gas stock in Europe, the numbers are around 90%. Does it mean that the countries have in stock around 90% of gas demand to go through the winter?
So over here, when we say basically 90%, it means that out of the total storage capacity that these countries have, 90% of that storage capacity has been filled, not as percentage of demand.
Diego, I hope that answered your question. Right, we have another question from an anonymous attendee. There are two questions. Question number one, why have spot gas prices decreased so much? And question number two is, when in the future do you think gas prices will go back to where they were 3 years ago? Thank you.
To answer the first question, the spot prices have recently decreased from the spike that we saw somewhere in mid of September, and some of the key reasons behind that have been, first, the rapid filling of the inventories that we have seen. So while the targets were to achieve 80% of the storage capacity by November, most of the Europe has around more than 90% filled storages. So that is giving some confidence to the market in that case. Secondly, some of the LNG supplies have also improved in the region. So like Norway, for example, it had certain plant outages back in August and September. Those have come back into picture, and that has been supplying ample cargoes to the market. And finally, there have been some for the start of the autumn, the the expectations for of temperatures are also towards the milder sector. So that these three factors are actually resulting in a decrease in the prices that we are seeing recently. And also European Union has been actively looking at some of the measures to reduce gas usage. They are giving some measures to intervene into power sector. So all these, this is also giving confidence to the market that going forward there would be some measures to regulate the market, and hence we are seeing prices declining. Coming to the second part, when in future do we see the gas prices? So this would be difficult to say at this point, honestly, because with the war continuing at this point, I think unless we see more clarity coming from the situation in Russia, it is very difficult for prices to go back to where we were seeing them 3 years back. While the prices may retreat from the highs that we have seen recently, I think they will still continue to remain around 50 to 100% higher in the next 2 to 3 years, definitely, unless we see a resolution in the Russia-Ukraine war.
Right. Material shift in the fundamentals of the market. So so difficult to predict. Agreed. Andreas has a question. Demand figures in your grain outlook, to what degree do they take a recession scenario into consideration? Kumar?
Yes. So certainly we have accounted recession in this, but not an extreme economic slowdown that may impact grains demand, because grains are something, even in during the earlier recession periods, demand has not dropped more than 2 to 3%. So in this scenario, while we expect a slight decline in demand because of recession, but that will likely get offset because of improved demand from the ethanol production units that we are likely to see coming up in the next year. And as we just discussed about a hike in energy prices, so ethanol demand will continue to remain there.
Thanks, Kumar. Kumar, I mean, we when we talk about recession, right, and we talk about aspects such as grains, I mean, these are essentials, these are staples.
Yes.
Do you really see like aspects such as macroeconomic recessions really impacting demand to maybe double-digit figures?
No, not at all, Sidharth, and that's what I said. It might impact slightly, but since, as you correctly pointed out, these are essentials and people will still continue to eat. And one thing which I'll also add here is because overall, as we also discussed during the presentation, that stocks to use ratio are very low. So a lot of importing countries are sitting at low stocks level, so they will continue to keep supply in pace, so that to maintain food security as well. So recession will not likely have a major impact on demand, and whatever impact it will have, it will probably get offset by ethanol production units that are coming. A lot of corn-based ethanol production units are likely to start in Brazil. Okay. And 2 of the wheat-based ethanol unit is expected to become fully operational in UK.
Yeah, thanks for that. Christoph, since NS1 is destroyed, the assumption for the best case scenario doesn't seem that realistic. Okay, not really a question, but a challenge. Nishita, for you, would you like to sort of just answer that?
Sure, Sid. So yes, I agree that recently we have seen, the supplies via the Nord Stream 1 being stopped completely. And yes, there are certain, the leakages have also been discovered under the Baltic Sea. However, our assumption currently is that we are expecting the resumption for the Nord Stream 1 coming by the end of this winter. So we are not expecting under the best case scenario coming before that. Now, in the best case scenario, I agree with you that it would be difficult to see that, but then again, the probability for that is relatively lower if you will see it, or where we are taking the assumptions. So we have taken the assumption that the probability for this would be definitely lower than our base case. So that's the case. That's how we have evaluated different situations.
Okay, Christoph, I hope that answers answers. And of course, if you'd like to sort of have a further discussion, please, we're open to having a deeper dive as well. Okay, so do you know? Sorry, another question from an anonymous attendee. Do you know if Russia are selling elsewhere the gas they would otherwise have sold to Europe? And if so, does it reduce the demand from countries where we want to source from, for example, Nigeria?
So Russia majorly supplies natural gas through pipelines to Europe, and therefore it is not possible, for Russia to divert those supplies to other countries. While it has some pipelines from Russia to China, but the ones that they're selling to Europe, if they have stopped it, they cannot reroute it to other regions. So that because of that, that is actually having a negative impact on the Russian gas production as well. So that it becomes difficult for Russia to do that. They can do it only through, via other transportation method, but through pipelines, it's not possible for them to reroute, which is the major way that they are transporting through to Europe.
Okay. Good. We've got 3 questions. I think maybe we can try and wrap this up very quickly. I think we'll continue for another 4 or 5 minutes. What is the likelihood that Ukraine grain deal will be retained?
So, given in present scenario where Russian aggression continues, and they have also announced annexation of about 4 Ukrainian occupied territory. In addition, Russia and Turkey have in past accused that grain deal, which was supposed to supply grain to poor nations, is actually not happening, and most of the grains are going to Europe. So considering all this scenario, we do not see that grain deal will likely continue post November 19, when the current deal will expire.
Okay, perfect. Pradeep's question: what will be the US role in LNG overall situation?
So US would definitely be a major player when it comes to LNG. It is the largest producer for natural gas, largest exporter in the market, and definitely it will have a major role, especially for Europe. Because if we see, as compared to last year, till July of this year, US has actually supplied close to 68% of its LNG to Europe, which was only around 30% last year. So definitely US would be a key player when it comes to the LNG market, especially for Europe, because they have also signed various deals with US to replace the Russian supply. So that's why, the restart of the Freeport LNG terminal, which sends close to 50 to 60% of its supplies to Europe, is very crucial for the European energy market.
Thanks, Nishita. We have a question from Olivier. EU is meeting this week to regulate gas and electricity market. Do you think it will have a short-term impact on electricity market prices? It's, I think, 550 euros for France today. What are your thoughts?
Definitely it will have an impact, because, and if we see how the market has been moving in the past week, when a lot of speculations are coming into picture as what measures or what proposals the European Union might take. We have seen that this has resulted, in a drop in prices, because we are seeing that they're rationing gas demand. For electricity, they are putting caps on, they're proposing caps on the electricity usage, etc. So definitely in the short term, it will have some impact on the prices we could see. But definitely, in addition to this, we also need to look at the feasibility of how the measures, what measures basically European Union takes, whether it would be realistically achieved, and that's how the long-term price movement would be for the electricity prices.
Thanks. Olivia, I hope that answers. Question from Michael. Would the cost of corn and grains go up even though production will continue in other countries due to high fuel prices?
Yes, certainly. So because of it's not just high fuel prices, the labor shortages, high inflation, and a sharp rise in fertilizer prices because of this Russia-Ukraine war has made the farming cost higher versus what it was last year. And considering the increased volatility in natural gas prices, where some of the producers in Europe are already announcing curtailed production, so fertilizer cost will likely remain elevated, and hence we expect input cost, which in addition to the finance cost, because of the hawkish monetary policy of global central bank. So clubbing both these together, farming costs will remain elevated in the next year.
Perfect. Thanks for that, Kumar. Michael, I hope that answers your question. Well, we don't have any further questions, and I would like to take a minute to thank our experts, Kumar and Nishita, who've done a fantastic job today of answering all questions and giving us all this great insight. And I hope everybody enjoyed this. It's quite an interesting time. We recently, have been announced in the UK from the National Grid as well that we might expect some blackouts in January, February next year, right? Which was absolutely unheard of, right? But it's a very, very interesting time for the markets, especially with everything that's happening. So yes, if you're concerned about how all of these events are impacting your supply chain, your categories, do reach out to us. We'll be more than happy to have a conversation with you, give you our views, and of course, more than anything else, to discuss basically what we're hearing from some of your peers in the market as well. Please do follow us on Facebook, LinkedIn, Twitter, YouTube for more content and insights from our experts. And till we meet again, goodbye and thank you.